Hi guys, welcome to Money Control. I'm Karunya Rao and with me is Santosh Nair and we're here with a brand new explainer. Today we'll be talking about what is an inversion in yield curve. But before we delve deeper into that, I want to talk about what are yields. Because typically in an inflationary scenario, when the markets are going down, there are fears of recession as well across different markets across the world. You often talk about yield curve and prices when it comes to bond yields. So talk to us about what are these yields?
So Karuna, when you invest in a fixed income instrument, I'm just taking, for example, here, a fixed deposit, right? The longer you park your money with the bank, the higher the rate of interest is what you should be getting, right? The inversion of yield curve here basically means that, the shorter you keep the money with the bank, the higher returns you earn. I know it sounds a little
bizarre. When
it
does
sounds,
that happen?
Yes. So this is what it's all about. So let's start with yields. So what are yields? Yields is basically the rate of return that an investor makes on a certain instrument over a fixed period of time.
Right.
Now let's see how it works. Now, for instance, you're buying a bond which promises to pay you 10% at the end of the year. Okay.
Right.
And the bond has a face value of 100. Okay. Now, if the face value is 100, your yield will work out to 10%.
10%, yeah.
It's 10%. Okay. Now, let's say for whatever reason, after you bought this bond of face value 100, someone comes up to you and say, look, just give me that bond, right? I need it badly. Okay. It could be possibly because interest rates have fallen and your bond is now very attractive because it offers 10% while the new bonds don't offer that kind of interest, right? Now you'll say, okay, I'll give you this bond, but at 102 rupees. Okay.
Okay.
Right?
Instead of 110 that I would have earned at the end of the year.
Yeah, you decide to
give it up.
Give the bond.
Yeah.
So 102. So the new investor who's buying the bond of you is now paying 102. So his yield will not be 10%. It will be 10 upon 102 into 100. And this works out to approximately 9.8%. Okay, his yield is lesser because he's paid the bond prices has gone up. Conversely, let's say you want to sell the bond in a distress.
Okay.
Right? And you say that, look, I'm willing to accept 98 rupees. Okay.
Okay.
Now, in this case, the yield for someone who buys that bond of you for 98 rupees, okay, it will be 10 upon 98 into 100. So this works out to roughly 10.2%. So you notice when bond prices go up, the yields come down. So yields and bond prices typically move in opposite direction.
Inversely related.
They are inversely related. Okay. Now let's see what's a normal yield curve.
Okay.
This is how a normal yield curve should be, right? The longer you keep, the better the yields on the instrument.
Okay.
Okay.
Like for example, if I put it for 5 years, my yield would be around 2.5%.
Right.
Okay.
Right.
And it will keep going up.
This is a normal yield curve or an upward sloping yield curve.
That's what we've learned, right? The longer you keep your FD, the more money you make.
Exactly. Okay. Now what happens here is that when you're referring to inverted yield curve, it's a downward sloping, which means that if you keep for 5 years, probably, just for example, you get 6.
Okay.
If you keep it for, let's say, longer, you get a slightly lower rate. You keep it for even longer, you get. So this is what a inverted yield.
But this seems very unnatural. So under what circumstances does this play out?
Okay. So what happens here, Karunya, is that bond prices, as I said, when bond prices go up, yields come down. Conversely, when bond prices come down, yields go up.
Right.
Okay. That's the relation here. So what happens is when the outlook on the economy is not all that good, okay, people tend to park their money, move their money into fixed instruments. What happens is as more people start buying bonds, okay, longer dated bonds, the price of that bonds go up because there's a lot of demand suddenly for those bonds.
Right.
Okay.
Right.
And when bond prices go up, it means that the yields will start coming down. So that is what we are seeing right now. There is a concern that probably the economy is already overheating. The Fed will increase rates, which it's been doing any which ways.
Right.
And once rates keep increasing, the economy will slow down at some point. When economy slows down, you'll see corporate earnings getting hurt, unemployment probably rising, and that's what market is worried about. And a lot of money now is going towards the longer dated bonds.
So if we talk about the US bond market, where exactly would you say it is at right now, and where it could be headed?
So see, it is what people typically, which two maturities people compare. Now sometimes it could be a 6-month bond yield which is being compared to a 5-year. That's one way of comparing it. The other one could be a 2-year and a 10-year. So again, it varies. But Karunya, the key thing here is it's not always a very reliable indicator.
Oh, okay. That's news, because everybody, when we switch on the news or we read articles in the recent times, most people have correlated that to how the markets are likely to perform, how the economy at large is likely to perform. So what are you saying?
Okay, so here's one thing, recession doesn't happen, very frequently. It happens once in 5 years or maybe even longer, right? Now, you haven't seen a recession since the global financial crisis. That was back in 2008, 2009. So it's been 13 years now, okay? So the history of recession is not very long, okay? So this is a fairly good indicator, but it is not a given that it should always play out that way. Now, in this case, there is a reason why the correlation has broken, as many bond market players have been pointing out. Okay, yield curve of longer dated treasury bonds in the US are down also for a reason. That's because the Fed has been buying those bonds to keep interest rates down. So the correlation is strictly not there. So that's one of the reasons some people say that, okay, in the past it's been a fairly reliable indicator, but it's still not a given that an inverted bond yield means that we are headed into a recession for sure.
Okay. I think, some economists also point that before there is a meaningful inversion, the curve plateaus. When is that? When does that happen?
So that is called the flattening of curve. That is when, the outlook on the near-term economy is bearish, and investors think that probably you're going to see now rate hikes coming, which could slow down the economy. That is when you have something like this, when it's almost similar, the rate on, let's say, a 5-year and a 10-year.
Okay,
or a 6-month and a 1-year. That is when it kind of flattens. But after flattening, typically, they tend to kind of again downward slope.
Do you see that happening right now, or I mean,
it's still anybody.
If one were to understand what's happening right now, can you mark it on the graph? Is that possible?
It's very difficult. See, it's still not clear whether Fed will continue with hiking rates as it is promised to. Okay. Now, some say that maybe, we could even be seeing the Fed kind of cut interest rates as early as, let's say, March or June of 2023, But in the meantime, there could be damage to the economy when the Fed keeps raising rates. Okay. So it's still not very clear. We have had many leading voices say that recession is imminent, then again, the magnitude of that recession, people differ on that. Some experts feel that it could be a mild one. Some say that it could be pretty harsh.
Yeah, soft landing versus hard landing.
Yeah, so it's still not very clear at this point.
All right, so this is what it is. Thank you so much, Santosh, for joining in and for decoding yield curve inversion for us. I hope our viewers are taking back a lot from this conversation, and they will know how to look at this very important indicator of the macros to also know more about the micros.